Good day, I am Ernest Mazansky, Head of Tax Practice at Worksman's Attorneys. Today was the budget speech that was given by the Minister of Finance in Parliament. I would just like to highlight a few key points that came out of it that would be of general interest to viewers. The days of radical changes in the tax legislation announced in the budget seem to have passed, but nevertheless there are a number of interesting points which are more than just technical. First, dealing with the tax side, the Minister announced in his budget last year the possibility of a reduction of the company tax rate from 28% to 27% this year. Well, it didn't quite happen, but it has been announced that it will apply from 1 April 2023 next year. So companies with tax years that end after that date, 30 June, etc., will pay the lower tax rate, not companies that end at 28th of February. Concurrently with the reduction of rate, last year the Income Tax Act was amended to broaden the tax base, and those amendments only were coming in when the tax rate reduced. Those two were changes relating to tax losses brought forward by companies. So whereas up to now your entire current year's taxable income could be sheltered by a brought forward loss, from next year it will be limited to 80% of your taxable income being sheltered by a brought forward loss, which means that tax at 27% will be paid on 20% of the taxable income. The other change related to the limitation of cross-border interest that would be allowed as a deduction, limited to 30% of EBITDA. And again, that will come in concurrently with the reduction of the rate. Interestingly, the budget documentation compares our rate to the average OECD corporate rate of 23%, and they make the acknowledgement that the large differential in rates is an inducement to tax avoidance by shifting profits from South Africa to a foreign jurisdiction, particularly in regard to multinational groups. Presumably, the 27% or the reduction to 27% is a first step, and hopefully we'll continue to see reductions as the tax base broadens, including by reason of the fact that a number of incentives are being allowed to expire and will not be renewed. Another point that might be of interest, particularly to retailers, is that there has always been a special allowance granted where goods are sold on installment sale or suspensive sale or hire purchase, depending on whatever word you like to use, where effectively the retailer would be taxed only to the extent of installments received. Now, hitherto these provisions have never applied for lay-by sales, including because typically those contracts are less than 1 year. It's been announced that the legislation will change that will allow these rules to apply for lay-by sales as well. Finally, a couple of years ago, brouhaha arose when government announced that it was going to tax unit trusts, collective investment schemes, on their share profits if they held the shares for less than 1 year. Collective investment schemes are exempt from income tax on sales of profits on sales of shares, including they're exempt from capital gains tax. And Treasury got very concerned about the fact that they're essentially dealing and yet not paying tax. The proposals a couple of years ago were scrapped, but now it's been announced that a discussion document will be issued this year to look into it. Clearly, this is not the last word that will be heard on that subject. Some interesting exchange control changes were made. As may be well known, the commercial banks or authorized dealers are able to authorize foreign direct investment by companies up to 1 billion rand per year. This threshold is now being increased to 5 billion rand per year, which means that it'll only be in quite extreme cases where it's necessary actually to make an application to the Reserve Bank itself for approval. Another quite interesting change, which relates to individuals rather than corporates, is the fact that when one sends out the annual foreign investment allowance of up to 10 million rand a year, you are free to invest that into an offshore trust. Those circumstances where one got approval to invest more than that a year, say 100 million, 200 million a year for very high net worth individuals, there was always a restriction that they may not invest that into offshore trusts, something which none of us could understand. Anyway, it's now been announced that those people will be allowed to invest those funds into their own offshore trusts as well. Finally, I'd like to just comment on the fact that from the beginning of last year, the concept of loops was supposedly abolished, where South African residents could not hold South African assets through offshore structures, and they abolished that, having changed the Income Tax Act to close any tax loopholes. It now appears that the Reserve Bank is getting quite upset because they're seeing a lot of people who are attempting to shift their ownership of their local assets into offshore structures by selling them to the offshore structures. And they said that was not the intention of the relaxation. The intention was to encourage foreign investment, not to encourage externalization of South African assets. They said there'd be a new circular. Nothing was actually in the documentation in this regard, but we await to see what developments there are. I hope this has been helpful. Thank you.
Worksman's attorneys, keep us close.